Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Today I'm going to take a quick look at Etsy. This is a company that popped up on one of my screens. I was searching for companies under 10 billion in market cap with growing free cash flow, growing revenue, and a free cash flow margin of above 20%. And Etsy popped up, and Etsy is a company that I'm familiar with, so I wanted to take a quick look. Did a quick analysis, like the stock. Full disclosure, I actually bought the stock not too long ago. I own it. Bought it in that low 70s range. It's still trading in the $74 range, so kind of around where I bought it. But again, I wasn't expecting this to go up in price anytime soon, so it's no surprise that it's still trading where it is. But I wanted to review it here on my channel just to give you an idea of what my thought process was when I was buying this. And when I bought it, it was a small starter position, one that I might build out to a bigger one if prices keep going lower from where they are today. So if you're not familiar with Etsy, and I think many people are, they're an e-commerce company focused on that handmade vintage space. They do a lot of craft stuff. They've carved out a really nice niche for themselves in the e-commerce space as the place to go to when you're looking for something unique. So yeah, other players are out there that are in this space, but I think Etsy is number one, the number one brand name in people's minds. And sure, there's competitors. Sure, Amazon Handmade is out there, but Etsy has shown sticking power. They have shown brand power, and they're doing relatively well. Now, obviously, the stock hasn't done amazing in recent memory. They've gone from a high of 280 bucks as you know, a year or two ago, down to $74 today. Year-to-date performance is pretty bad, down about 30%. Similar performance 1 year out, 3 years out, etc. Not the greatest performer unless you bought it prior to the pandemic, and it did really well in that time frame. Growth just kind of took off. 100% growth year over year, and now it's slowing down simply because they've kind of capped out, right? Obviously, this is discretionary spend. As the economy struggles, Etsy will struggle. If people have to choose between groceries and or random goods on Etsy, they're obviously going to go with groceries. So gross merchandise sales are slowing, and I think the reason that the stock has been punished is that the future certainly looks a bit more murky and the growth just isn't there. However, I think this is still a company that generates a ton of free cash flow, and that's important because they'll be able to reinvest in the business, buy back shares, do whatever they want to do. So Etsy is the majority of the business. They do have some other subsidiaries. There's Depop, which is kind of a peer-to-peer secondhand clothing store that they purchased for a ridiculous $1.6 billion in 2021, I think. So that was a big overpay, so a big misstep on the part of management. This is a business that maybe generates 60 to 70 to 80 million in revenue, so the price over sales multiple was pretty ridiculous. And it is growing a little bit, but it's not growing nearly fast enough to justify that purchase, and they've already written down basically $1 billion of that. They also purchased another business called Elo7, which I think was kind of like the Etsy of Brazil that they've already sold off this quarter. Actually, they were like, we're out of the Elo7 business. They probably sold it at a loss. And then there's Reverb.com, which sells vintage musical instruments and such. So let's look at their financials here. They are slowing in growth. Like I said, GMS, gross merchandise sales, basically flat, slightly down on a currency neutral basis. The nice thing about Etsy and their business model is that their take rate is relatively high, so they are able to kind of either increase the fees they charge to the sellers, improve their services side of things, which are things like Etsy ads, and still grow revenue at 7.5% despite GMS being flat. And then you've got this high EBITDA margin, similarly high free cash flow margin, because a lot of this EBITDA flows down to free cash flow. Their conversion is like 90% plus, simply because they are not a cash needed business. Really, they kind of, they have this marketplace. There's some obviously marketing expenses, there's some R&D in terms of improving their product, but a lot of this stuff kind of flows down to the bottom line, which is really nice, which is kind of why I like this business. Even if they don't grow a ton, they can still generate quite a bit of free cash flow in the next couple of years to make this investment quite interesting, and that's kind of where I'm coming from. So you can kind of see there's some decent metrics in this earnings that they quickly pointed out. It's like, hey, yes, our GMS is kind of bad, but the growth rate is improving sequentially. And then if you look at actual monthly GMS, it's actually growing in May, June, and July as well, which kind of says, hey, we're pointing into the next quarter, and it's starting to improve. Buyers are at an all-time high. Buyer additions are improving. Positive growth rate outside of the United States. So there's an international expansion as well. They do have a couple of international markets that they're already in, Germany and such, but they are expanding into other areas internationally as well that have as much GDP as the United States. So they're probably targeting like 15 different markets. They're making investments in, AI, all of that nonsense mentioned on this call as well, kind of talking about their product. You can look at it here. I'm not going to talk about it too much. AI, machine learning, all of that stuff, improving the seller experience, improving the buyer experience, all of that nonsense, making the machine learning process easier under engineers. And again, focusing on Depop here. So GMS is growing at 25% from Q4. Decent momentum here. But again, this is still a business that they paid a ton for. This is 2021 when everybody was buying something at ridiculous valuations. So probably an overpay. They could have probably kept that money, done stock buybacks with it at this point, but it is what it is. Their balance sheet is still fine, but it is a little bit of a misstep on the management part. Reverb was a buy a longer time ago, but it gives them something different, right? It's different areas for their business to grow in. And if you look at their $3 billion in GMS, Etsy itself probably makes up about 2.6 billion of that. So Depop and Reverb between the two of them. I think that it also includes Elo7, which is getting spun off to another company. Those three made up about 400 million on their own. So it's a very small part of their business, but it's growing at a slightly faster clip than the bigger part of their business, which is obviously as you would expect. So you can kind of see the problem with the stock and why the market is starting to punish it a little bit. GMS is basically flat. If you look at GMS in Q2 2023, despite inflation, despite all of that stuff, it's down about 200 million from Q1 2022, right? So that's not great. The nice thing though is that despite slowing GMS, revenue is actually up quite a bit, 579 to 629. Q2 to Q2 23, it's up 7.5%, and then EBITDA's up as well, even though there's some pressure on margin, and that can be seasonal, but also it could be due to higher investments in some of their ML stuff, machine learning stuff, some higher marketing spend, all of that stuff as well. And you can kind of see, so what's growing this revenue despite GMS that's slowing or not growing at all? Well, it's services. Services are up 20%, and services means like Etsy ads, Etsy payments, etc. Is really helping to drive that, adding incremental revenue, and that could potentially be a higher margin business, especially on the ad side as they kind of grow that out. And if you think about ads themselves, as they become a bigger part of their business, that can be quite beneficial to long-term margins, even though you're not seeing it from the short-term perspective. And you can kind of see, well, what's driving this margin shrinkage? Well, we're spending a bit more money as a company on product development, all of that stuff. Marketing is relatively flat, but you're seeing some of that in hopefully better results on a go-forward basis and a trend that's moving in the right direction. So you can kind of see positive growth year over year on the GMS side, and they already said that Q3 also was positive, so potentially a little bit of a sign into what we're going to see in the next quarter as investors. If you are an investor, kind of going into their clientele, whether it's repeat buyers, habitual buyers, new buyers, active buyers, etc. Then a little bit of their balance sheet and the free cash flow we talked about. You can kind of see 660 million in trailing 12-month consolidated free cash flow. This is that free cash flow margin that I mentioned that popped up on my screen. And then you've got really solid cash balance and then guidance that kind of points to another 6-ish% growth rate for Q3. So that's the earnings. Nothing amazing. I think the market didn't love it because there's no clear sign that we're going to get actual growth on a go-forward basis. If this is the top of the revenue, the top of their GMS, could be a bit of a problem. Like I said, very discretionary spend here. The consumer, if weak, is not going to go to Etsy. They're going to go to the grocery store, and that's going to punish them from a short-term perspective. Again, it's relatively cyclical as well, discretionary spending. If discretionary spending goes down, it's not going to be down forever, but short-term spending cuts will certainly punish a stock like this. Taking a look at the financials, jump into the balance sheet real quick. Pretty good balance sheet. You can kind of see the $1 billion in cash they had on the balance sheet. They do have about $2 billion in debt. Most of that is from that $1.6 billion acquisition, which was poorly timed, poorly thought out. But the balance sheet itself is pretty good. You can kind of see the goodwill that was basically written down from 1.3 billion down to 100 million, so $1 billion plus write down in recent times for the acquisition that they made. And then cash flow itself, you can see the asset write down here, but the cash flow itself is solid. Decent cash from operations, very low capex, and then cash flow in that 600 plus million range. So that's not an issue. Good cash flow generation. If you look at their valuation today, from a historical standpoint, it's about as low as it's ever gotten. There were some times not too long ago when they were about that time, but you're sort of near the highs. The last is about at 7.3%. The high ever is 7.7, but before then, it's really never gotten there. Even during the crash, the pandemic crash, right? It was kind of there. So valuation is pretty good if you think this is a business that has lasting power. If you don't, obviously it doesn't really matter. It's going to go out of business eventually. But if you think that they have lasting power, they can grow in any sort of way in the future, keep margins where they are, might be an interesting valuation. So let's look at how I view this company. Again, market cap sub 10 billion at 9.2 billion or so. When I look at this at the $64 price point, they have done a pretty good job with buybacks recently. Sometimes these were bought at higher prices, but they do have a $1 billion stock purchase plan in place right now. Some of that is offset by an increase in stock-based compensation that has popped up a bit recently. So that's something to keep an eye on, especially as the price increases. But maybe in order to retain some of their more talented AI engineers or machine learning engineers, they have to offer them stock based compensation, and that could be a bit of a problem. But as long as they're buying back more shares than the stock-based compensation, which they are, that is a good thing. They do not pay a dividend, but certainly in the future, as growth slows, this is a company that I could see paying a dividend a couple of years from now because they are a cash flow machine. And once growth slows, they either look outside to acquire, they buy back more shares, and or potentially institute a dividend a couple of years down the road. So estimates here are pretty decent. These are analyst estimates that are kind of saying, well, we're going to grow at 7 as a company, up to 12% by 2027. Margins are going to increase. Don't know if this is all realistic. For me, it seems a bit aggressive. Growth rates are slowing, so they're not suddenly going to jump up again. Margins are shrinking, so they're not suddenly going to jump up again up to 29% by 2027. I do think they're going to continue their buyback. So I have about 30% of their shares being bought back, of the free cash flow, going to buybacks, which is about 1.4 billion in this case. Again, lower than the 1 billion in their announced, higher rather than the 1 billion in their announced stock buyback plan. But that is, going to be renewed eventually. That's only for the next year or two. And then some of that is going to be offset with stock-based compensation. But if you think about it this way and you believe in some of these analyst estimates, which are probably aggressive, you can kind of see, well, this is a 15% return, even if free cash flow yields stay the same. Because right now, this, like I said, it's a 7.3 free cash flow yield that you're getting at today's prices based on 2022 actuals. If you see growth and margin expansion and no increase in valuation, it's a 15% annual return. Close to basically doubling of the price point from today by 2027. If this were the case, if you actually see increasing growth and increasing margins, I think the market would revalue this. And you're talking anywhere from 15 to 23% an annual return. I think this is way, way too optimistic. I'm not saying this is what I believe. I just don't believe that they're going to start growing again, that they're going to start expanding margins again that quickly. I think a more realistic scenario, and this is kind of my base scenario, is hey, growth is about 7% this year. It slows a little bit in the next couple of years. I think that's reality. I think this is a business that it's not really reaching its peak, but it's kind of getting to a mature stage where growth is going to be slower and slower and slower and potentially kind of start to get back to an inflationary growth range by 2027. I think at that point they'll start thinking about, well, maybe we're not really a growth company anymore. We're instituting a dividend. We're focusing on buybacks if the market is still valuing our shares low. I think margins, they stay about the same. I think more of their growth is going to come on the services side, which could potentially lead to a margin increase. But I would assume they stay about the same. The reality is there's been pressure on margins in recent quarters and in recent years. So staying the same seems realistic to me. And at that level, they still institute a buyback. They buy back about 35% of their free cash flow in buyback totals. Obviously, some of that is maybe offset by stock purchase, stock-based compensation, etc. That is an interesting base case that makes for about a 7% total annual return, which isn't amazing. Which you look at it this way, it's like, well, 7% is not bad. But what I kind of like about this is that the downside is relatively limited. If the market starts revaluing this to a lower free cash flow yield because growth is slowing, because interest rates keep rising, even if there's a little bit of margin pressure or a little bit of growth pressure, the downside isn't that bad, but the upside is decent, right? You look at, hey, maybe the market starts to like these companies. Maybe they're paying a dividend at that point, and the free cash flow is relatively steady, and they've weathered a recession relatively well, or what have you. Maybe the market gives it a 5% free cash flow yield or a 6% free cash flow yield, and or interest rates start going in the opposite direction, right? If interest rates start to suddenly drop into 2 to 3% range, then stocks like this are going to get repriced to a slightly better multiple. And then that level, even at 7%, you're looking at a 7.6% annual return, down to 14 to 19% at a 5 to 4% cash flow yield, respectively. That's interesting to me. It's interesting to me because I think this is a company that, one, has a good balance sheet, which means that if a recession does happen and their sales get cut, they can weather it pretty well. They don't have a ton of debt. They are going to generate more cash before that happens and be able to pay some of that debt off. They already have some cash on the books. Secondly, this is a company that even when their revenue was a fraction of what it is today, was generating free cash flow. So even if their revenue drops 50%, I think they can pretty much maintain their margins. They can cut back on spend. They can probably, unfortunately, do some layoffs. They can cut back on marketing spend. They could cut back on R&D spend. So this is not a company that even in a recessionary time where revenues drop quite a bit is going to suddenly start burning cash. They're going to be able to generate free cash flow at a much lower revenue level. And that's quite interesting to me. And if they are able to exceed these targets, if they are able to sort of grow some of their services business, increase their margins, etc., the upside here is substantial. The upside here is going to be quite good. I can just sort of say, well, even if their revenue doesn't grow as much, maybe their free cash flow margins start improving, and suddenly you're looking at 7.6% returns on a base case. And if margins are improving, the market's definitely going to revalue this, and you're looking at 11%. So it's not amazing, but it's decent. And the downside seems relatively limited to me because this is kind of that business that kind of chugs along, might not grow as much anymore, but chugs along, produces free cash flow, does stuff with that free cash flow in order to give back to the investors in the form of buybacks. I think eventually Etsy is going to be paying a dividend. I'm looking at 5 years from now where if they're generating this much in cash flow, they're using some of that for stock buybacks, but some of that is probably going to go towards a dividend of some sort. This is maybe a business that's maturing, but if not, then that's even more upside for the investor. If they start to grow again, if they make some interesting investments, if discretionary income comes up again, if the consumer gets stronger, if interest rates drop, a lot of ifs in there, but this could have a potential for a ton of growth. You can kind of see the upside here. And the obvious upside, if growth ticks up, if margins start ticking up, let's say they end up at 27% margins, kind of how they were in the past, in 21, you're looking at a base 10% return, revaluation into that 10 to 20% range. That's pretty good. Obviously, there's a bear argument to be made here. Growth starts to slow even faster, margins get cut even more. You're talking about a 4% return. But even in this case, a revaluation just kind of puts you at even. And in a market like this, where a lot of deals don't really exist, this doesn't seem too tremendously bad to me. Once the market starts to revalue some of these companies based on their cash flow, even if they're slowing, if interest rates come down, even with slowing growth and margin pressure, this could still return a decent amount. You can kind of see, hey, a 6% valuation gives you a 7% return annually. And obviously, things could get a lot worse. That's always the case. You could always say, well, some other company is going to come out and this company is going to start shedding business. They've grown a ton during the pandemic, and this is kind of the new norm. And maybe this is as good as it's going to get, and their revenue is actually going to go down from here. They're not going to be able to put as much pressure on their seller base in terms of increasing their fees to bring up their take rate. Ads won't work as well, etc. Amazon Handmade's going to cut into their business. Amazon's going to do something. Amazon's always the big elephant in the room. I could potentially see these guys getting acquired by somebody who wants to sort of get an easy, easy 7 to 8% free cash flow yield, depending on how much they're buying them for. That is a lot of cash that this business throws off that could help another business grow, another business increase their margins, another business increase their revenues. And hey, maybe even Amazon picks them up and says that Amazon Handmade isn't growing as well as we thought it would. We're going to add this to our bevy of businesses that we own, or some other larger retail player picks them up to sort of get things going. I don't think that's going to be the case. That's not my thesis here. My thesis here is that this thing kind of chugs along, doesn't necessarily blow the door out the water in terms of growth, but growth is still sort of there, even if it's slowing. Margins remain steady with upside if revenue grows faster or margins grow faster. At today's price point, this isn't a bad deal, even if you believe these margin pressures are there and you want something closer to a 10% return at today's valuation. You probably just need a price point in that $55 to $60 range. So, maybe downside is in that 20% range, which isn't horrible, but I think upside is pretty solid. And again, started a small position here. I would always think about building it out if the price keeps dropping. If it drops into that 60 to 65 range, I'd probably really increase my stake here. This is not a huge holding for me. It's a very small holding. Let me know what you guys think about Etsy. Let me know if you guys disagree with anything I've said here. Certainly some bear arguments to be made. Discretionary retail is not going to do well in a recession. So short-term price pressure could be there for sure. Totally believe that. But from a long-term perspective, as I look out post-pandemic, post-recession, what businesses will survive? What businesses have a balance sheet to kind of weather a storm? What businesses have the margins to be able to actually generate free cash flow, even if revenue gets cut quite a bit? And I think these guys are one of those businesses. They're discretionary, but they've carved out a pretty good niche. Probably not something you consider like a website that's going to be around 30 years from now, but they might be. They've only been around since 2005, so it's not like they're a very mature business and things can change really quickly. But I think they have a niche that they've carved out that's a unique one that's kind of hard to replicate. And their brand cachet is there, so I don't hate it. That's all I'm saying. Usually retail I'm not like a huge fan of unless the deal is very, very good. And the deal here is pretty good. It's not very, very good, but it's pretty good. Good enough for me to start a small position. So let me know what you guys think. If you agree, disagree, leave a comment down below. If you enjoyed this video, leave a like, subscribe, all of that stuff. Welcome to everybody who's new to the channel. Thank you for all the subscriptions, etc. As always, guys, I am not a qualified financial advisor. Please do your own due diligence before investing. I'm just doing these videos for fun and kind of talking through my own investment process. So let me know what you guys think. Thanks.